I had a comment from somebody in a previous video, and in answering it for them, I realized that it's actually a really good question, and maybe some other people out there are also wondering the same thing. Now, if you have any questions of your own for any of my videos, I'd love to hear from you, so go ahead and leave a comment down below. But essentially what was asked is, when I'm measuring my own investing performance, why do I use the S&P 500 as a benchmark? So that's a good question. Now let me explain why. So to give you a little bit of context here, let me show you the charts for all three of my trading strategies. You can find these on my website. If you're interested, you can check that out later. The first one here is the tactical volatility strategy. And as you can see, the benchmark that I'm using is the S&P 500. I use the ETF called SPY because it pays dividends, which increases its performance quite a bit over time. This here is the tactical balance strategy that rotates in and out of positions in stocks, bonds, or gold. And again, I'm using the SPY for comparison. Lastly, my iron condor strategy, which is a derivative strategy, and as the name suggests, of course, it trades iron condor option spreads. And again, there's that S&P 500 for comparison. When I combine all three strategies together, I call this my total portfolio solution, and it looks like this. The only change here is, along with the S&P 500, I've also added the HFRI Hedge Fund Composite Index. Just a broad measure of hedge fund performance. So the number one reason why I do this is because the S&P 500 is a globally recognized benchmark. Every investor from every country out there knows what the S&P 500 is. And whether they trade it directly or not, at the very least they use it as a reference point in some capacity for their trading. The US stock market is really the global benchmark, and it's what most investors out there are trying to outperform. And as you may have heard at some point, statistically speaking, about 85 to 90% of active fund managers out there don't actually beat the S&P 500 in the long run. So if a strategy can beat it through good times and bad, stretched out in the long run to include bull markets and bear markets, it's probably a good strategy. So that's the biggest reason why I use the S&P. There's no benchmark that's more globally recognized and serves as such a good investing target. But now to get more specific with the question that was asked, with respect to my tactical volatility strategy, why don't I use the XIV as a benchmark? It is a strategy that trades the volatility products XIV and VXX, so why am I not using one of those as the benchmark? Let me give you two reasons. First, almost nobody buys and holds the XIV, so in a practical real-world sense, it's pretty meaningless to use as a benchmark that nobody actually just holds. Now, of course, one of the reasons we use benchmarks is to compare similar strategies or similar asset classes, so it is a valid question. But in the case of volatility products, there really aren't any similar assets aside from the ETF itself. And since A, nobody buys and holds the XIV because that would be investing suicide to do so, and B, I'm also using inverse products as well as cash in my strategy, so it becomes a pretty meaningless comparison. But another point of a benchmark is to provide a viable alternative investment to the strategy in question. And for most investors out there, volatility trading or investing in the stock market will both fall into the higher growth category of their portfolio. Since millions of people do buy and hold the S&P 500, and it's in a similar risk category, it is the most meaningful comparison we have. The second reason why I don't use the XIV as a benchmark is because I feel like on some level, it's kind of a cop-out for the fund manager. At some point in the future, when the next recession hits, it'll happen again, and when it does hit, the XIV will likely lose about 80 to 90% of its value. It could very easily, and to be honest, probably will retreat back to the same price it was at 6 years ago. Quite a few volatility traders out there are way too aggressive, and I've talked about this a lot in the past. Their short-term results may look impressive, but in the long run, the drawdowns are pretty big. But most investors don't have the risk tolerance to stay the course through that. They'll pull the plug. They'll panic sell, and they won't be there to benefit from the subsequent recovery. So in the future, if the fund manager does suffer one of those big drawdowns and the clients are looking for an exit, they'll be able to say, well, sure, it's bad, but look at the benchmark, it's even worse. Now, I'm not making any blanket statements here that everybody out there who's using the XIV as a benchmark is doing it because they want an excuse. But intentional or not, it does sort of provide one, which I don't like. However, if you use the S&P 500, which pays dividends that compound over time, has a very low expense ratio, so it's virtually free to invest in, that at least 6 out of 7 years, it performs pretty well, so its risk-adjusted returns like the Sharpe ratio and the Ulcer Index, they're pretty good. Institutions, pensions, large funds around the world invest in it every day, so its own popularity sort of gives it some added protection, and it very likely won't suffer an 80 to 90% drawdown. The bottom line is the S&P 500 and about 90% of fund managers around the world will attest to this, is actually pretty tough to beat. But outperforming the XIV in the long run, that's child's play. Anybody can do that. So those are some reasons why I choose to measure my performance against the S&P 500. I want every one of my individual strategies to outperform the S&P on their own, so that when we combine them in a diversified portfolio, which you see here, it's impossible not to crush the S&P. I also throw the hedge fund index in there because, well, I don't really know why people invest in hedge funds, to be honest, but it's there for people to see. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comments section. See you next time.